Hi all, myself Ravi Kumar Vallemoni. I'm working as a information architect in one of the leading bank. Majorly, I was my contribution in the financial institution is the banking sector, regulatory and also the modeling and governance and the enterprise, the migrations from the different vendors. So when I say regulatory means there are a couple of regulators we have it. One is a Basel, one is a FDIC, other one is like a CCAR codes. So in this session, so we are talking only on FDIC. There are certain limitations for FDIC, so then we are talking only in FDIC. And so just giving the little bit more background about myself. So I'm a data architect and working as a data modeler and also a couple of migrations I'm handling it, and also I'm the member of that governance review. So if any model or any design you want to implement in a banking sector, in a bank, into my line of business, so me and along with some people, so uh, we are going to define that or review those models, okay, and in a mapping spec and everything, whether it's feasible to deploy in the environment or not. So that is one of the job also there. And also we do some implement a couple of modern technologies like an ISO standards, especially like a payment area and Brazil payment and ACH and HW and global banking. So while bringing the data from different regions to bank, so we don't need to do multiple changes. So that is the reason we follow certain guidelines as per the ISO banking standard. So it's easy for that upcoming models too. Also, uh, while working on regulatory models should follow certain guidelines and also should able to have the flexibility to trace back to the source if needed. Why? Because regulatory are it may come back to the bank again. If you have any questions from the external regulatory authorities, then we should be in the position to trace back to the source what originally happened. Okay, so let's go back to the topic. FDIC. So FDIC is a stands for Federal Deposit Insurance Corporation, and we so we're talking about what is an FDIC. Okay, now why we need to submit those things, and if what happen if we are not submitting it, and who has to take care of this one is who has submit those kind of regulatory reports. Okay, so before start that the topic, okay, so let's see that what happened in the banking industry. So if you take back to 100 years, okay, so 1929 to 33, so the recession was happened. The bank, all banks went to crisis because of people are keep on withdrawing money from their banks, and if bank doesn't have any liquid amount, then it's too difficult to run the business. So the bank process will be taking the money from the deposit money and giving the loans to the different areas or sectors, maybe automobile or kind of thing or construction or whatever it is. So they give like commercial loans and consumer loans and those things. If bank doesn't have any money, then it's too difficult to run the business. So that time the federal government is understand the scenario, so why that bank people are withdrawing money, then they understand that reason people are doesn't have any trust on the banks. So if they have money in their deposit account, and if some unexpected news is coming up, then people will little bit scared to maintain the money in their banks. So to avoid that confusion, so federal government implemented one agency called FDIC. So FDIC is a Federal Deposit Insurance Corporation. That insurance corporation is giving the guarantee for the deposit amounts, where people can hold the money even though bank fails, still customer money will be paid by some agency. That agency called as a FDIC. Okay, so when it is implemented, so people are started trusting that banks, and after that, from 1933 to almost 80, almost 50 years, almost like 40 or 50 years, it's running smooth. Then there are rules are little bit, some of the liberal rules are there, some loan sector and saving sector, and certain loans are given a poor regulatory guidelines. Then still in 1980 to 90 also, all banks are see couple of issues. Okay, so interest rates are high. Okay, and like so many loans are like little bit risky loans. Okay, so then customers are not able to pay. That time bank is liable to the other customers, those who are putting deposits. So that time almost 132 billion that all banks are like went on bankrupt. I mean to say bankrupt means they lost all 132 billion approximately. So the capital amount is not having, capital amount doesn't have the sufficient amount. Now after that, in 2008 also, so maybe like in 1990, after 1990, so banks giving little bit enhancement, done some little bit enhancement, okay, to the regulatories. And after that in 2008 also we see like the global financial crisis. Okay, so that time also it's same thing, mortgage thing, all mortgaging thing, loans are went like a foreclosure kind of thing. So that time bank is still they gave the loan to the people, they gave loans to the people, so people are not able to pay, then they went for foreclosure. So many houses are there, and the housing market went a little bit down. That time also banks are went to like failed. So especially like so Lehman Brothers also failed. So that's one of the biggest one. And after that they enhanced a couple of rules, and most recently you see Silicon Valley Bank also went to banker like failure. So every AC is keep on changing the rules and regulations. Okay, and people are like if people are started like trusting the banks. Okay, if compared to 1922, so nowadays also, so people have started trusting. Okay, so still bank, if a bank is failed, then someone will be able to accommodate that money to the customer. Okay, so by looking at this history, um, let me show you how the bank's count is being decreasing back in like 100 years, from 100 years to today. So there are many small business banks also there. So back in 1920 to till 2024, so you see number of banks in United States, like 30,000 banks were there. Okay, and after that, like nowadays today, so 4,600 banks. So and so many banks are being the close their business, or some banks may be merging together. Okay, example, Bank of America and Merrill Lynch was both merged together, and also SunTrust and BB&T Bank merged together, become as a Truist. So those kind of examples, like so many banks are merging together, and also like close their business too. So and these are like number of bank statistics. So let me give the like how that statistics are there for the bank failure statistics. There are then 99,000 banks are like were failed in 1929 to 33. So that is a biggest number. And so in 2008 also we see some banks are closed. Okay, around 465. Okay, and in that time, and so since 1933 to today, okay, so almost 5,000 banks are closed. Okay, so it means like after 1933, so the FDIC has been introduced in 1933. After 9,000 banks are closed. Okay, then so 465 I gave in 2008. Okay, and keep on, every year keep on running. It's not a crisis in between, but the small failures are happen. One or two banks or like 10 100 banks are keep on closing it. So since FDIC is being created, okay, as of today, almost 5,000 banks are failed. Okay, and recently 2023 also Silicon Valley Bank or Republic Bank also, like those are some issues. Okay, Signature Bank, so many things. Okay, so these are like closer statistics. Okay, and what is an FDIC? So when you go back to there, so what is an FDIC? Okay, so FDIC stands for Federal Deposit Insurance Corporation. So this is a separate independent government agency, and and the purpose of this one is, we federal government has to give a confidence to the public. Okay, yes, you have a money in your deposit account. Okay, then the agency will be assured agency, government agency will be there, where it will pay the money back to the customer if bank fails. Okay, suppose suddenly the one bank is shut down or they close the business. Okay, then who has to pay the money and for the customer, and who has a account in that bank? So the FDIC will handle that kind of scenario. Okay, they can able to. And there is a question like how much money FDIC will pay. So amount will be like the maximum amount of 250K per account. Okay, if the bank fails, if you have customer has a amount of maximum 250K amount in a given account, then they are ready to pay. It not included the joint account and a single account. Okay, so if the person is having that independent account, and also he is a part of a joint account, so he is eligible to get the money for each individual account. Okay, so 250K in one account and 250K in another joint account. Okay, so he is eligible. It's not a combined account. Okay, so and who will do that generally? Okay, so who will do that? So regularly, thousands of banks are in safe. Okay, and every time FDICs keep on checking their customer data from the banks, or the bank is keep on submitting all the report customer information to the FDIC, maybe like a quarterly. Usually I understand that's a quarterly. So every quarter end, each and every financial institution, all bank has to send the report to FDIC. So how many customers they have it, okay, and how much amount they have it, okay, their balance and everything. So in upcoming slide I'll show you what information they're going to send it, okay, and so then after this one, then FDIC has that information, okay. So what is they have the protecting all the customers. So if you go to any of the banks, for example like Wells Fargo and Bank of America, if you go there, so they have there is one logo has been displayed in each and in the lobby, bank lobby. The logo is FDIC, means each and every account is tagged to the FDIC, means even though you have money of like $10, still you are eligible for FDIC. So you don't need to pay any single dollar to maintain that insurance. Government banks will be taking care of those insurances. So you just have if you open a simple account, if you go with simple checking account, then automatically your account is covered by FDIC. So you don't need to specifically request my account should be tagged to the in FDIC. So that's the default process. Okay, so we'll go to next slide. Okay, and why bank has to submit to FDIC? What is the purpose? Okay, so it's compulsory, is a law. Okay, that federal government law. Okay, and you have to submit. Okay, so mandate all FDIC institutes has to report information to the FDIC to examine. Okay, so this all the customer, all the balances and the customer information has to send it to FDIC, and the customer FDIC sees that what how many customers they have it, how much balance bank is there, and how much assets they have it. Okay, so like if something goes wrong, okay, then is the bank is able to accommodate to the people or not. Then based on their report, they keep on working with the bank every quarter. Okay, so I'll show you next slide how what the process. So, and also each and every account is having a insurance coverage. Okay, so that each and every account is having insurance or not, so they'll send the information too. So if I have an account in some X bank, okay, so my information will submit to FDIC, and while submitting to FDIC, so they should specify whether this account is having insured or not. Okay, so that the tag will be there. Okay, if tag is not there, means what is the reason generally. So there could be some of the accounts generally they don't cover under FDIC, but we'll discuss in the couple. And also the purpose means other also people has to trust. Okay, so people has to trust the bank. So if Silicon Valley Bank, for example, in real time example, so Silicon Valley Bank is went under the fail, bankrupt, then what happened when the bank is went fail, people have started withdrawing money from other banks too. Okay, couple of people. Okay, so like in bank Wells Fargo or in Bank of America. Why? Because maybe some people may be scared, but if the people are having an idea, okay, about FDIC, then you don't need to worry. Okay, it will managed by the federal government. Okay, if you have amount more than 250K, then that's a different scenario. So where we are not talking in this session. So if you have a money under 250K, then you don't need to worry about anything. The federal government so will cover you the entire amount, whatever the amount you have. They know each and every transaction what you do. Okay, and also other important thing is the systematic stability. Because of this one systematic stability, so each and every quarter they'll see how much amount is deposit in the bank, okay, and how much loans bank is given, and how much assets they have it, and how much loans they gave it, and how much fixed income or how much collateral they have it, okay, and how much assets they have it. So it's so much of information they're calculating in each and every quarter. So that will be like stability is every quarter they'll try to check the health check kind of thing. They'll try to check the how that bank is doing doing the job. Okay, if something is going is able to accommodate all the customers or not. Okay, so what kind of accounts are being covered in this FDIC? So checking accounts, okay, including like general checking account, or like saving account are there, okay, which are having the interest accounts and interest bearing accounts and non-interest bearing accounts, both will be covered it. Okay, and also some money market accounts. Okay, and also like so check deposit, certified deposits generally. Okay, time deposits, and also that checks, money orders, like expense checks, and so loan disbursement checks, and everything is covered. Okay, and also prepaid card also. This is also prepaid card means is a card type. Okay, it's not account, but still it is considered an account. Why? Because suppose prepaid cards will be issued based on the is kind of thing, one of the account kind of thing. Suppose my company is giving they want to give some kind of bonus to me, so some company they don't put in the account, they'll give one card. Okay, so they just give one card. It means that still they issued a card, a Visa card or kind of thing, Bank of America card or Wells Fargo card. It means that they have it treating as like same account. Okay, that's checking account. They have money. Okay, if bank is failed, then automatically this information, this is also one of the considerable account technically. So we have to pay for these guys also. So they have the different card numbers and all. Instead, they don't have, maybe they may not having any account number and all the information, but they have some card number, everything. Okay. So while issuing the card, they have all the information. Okay. So then address and everything, something goes wrong with the bank, so then FDIC will be covering it. So prepaid card also one of the account level product. Okay. So and they'll treating as account level product. Okay. And and also, like, how much is covering it. Okay. So then if it's a single account, okay, and as I mentioned earlier, if the single account, still you are eligible, and also your joint account also, one or two people also, you are still eligible to cover it. Okay. So if you have a single account and a joint account, still you are covering, you are eligible to take 250K in each. Okay. And also retirement account. Okay. So traditional RAT account. Okay. And IRA account. Okay. And also trust generally, so those who are payable for, like, so individual trust, so that also still covered. Okay. And also government account generally, and also, like, so deposits owned by some corporate companies, those also will be covered in the FDIC. So the couple of things are not covered. Okay. So those things will be, if you have stocks with like Fidelity or like a Vanguard or Robinhood, so those stocks or bonds investment, those will not cover. So those are, like, those are not a fixed amount. Okay. So it's a market risk. And also mutual funds will not covered, and ETFs, exchange trade funds, also will not covered. So annuities and loan insurances also will not become under this FDIC category. And also safe box, that lock box generally. So maybe I'm not sure how that is going on bank fail, but still, whatever the amount or you have any kind of gold or anything is there with the safe box, those also will not be covered. Okay. And crypto also will not be covered in the FDIC. Okay. So, and how do you know, like, when you have account, how do you identify whether your account is eligible for FDIC, or it's already covering by FDIC or not? There is a, like, FDIC Electronic Deposit Insurance Estimator. Okay. So there is a EDIE is there, like, in a portals where you can able to see the, by giving certain inputs, and you can see that how that whether your account is being covered by FDIC or not. Okay. And so that is like, and you just need to see that. Okay. So how to calculate the coverage is also, like, based on the some inputs. Okay. So it's a tool, one of the tool generally. Okay. Whether your account is fully insured or not. Okay. So, and and also your deposits are held. Okay. So put some dollar amount generally, and you can deposit in the insured bank generally, or kind of thing. So that is one of the tool we have. Okay. And how that insurance is paid actually. Okay. It means that if bank is failed, so your primary bank is failed, then what happened after that? Okay. So when a bank is failed, then the bank authority, okay, bank's authority generally, and so typically set up the close the account and brings that into the, like, FDIC agent will be kicked off. Okay. So I mean, like, it will be not, I'm sorry to say, like, so agent will be, FDIC will be kicking. Okay. So when the bank fails, then FDIC come into the discussion, and FDIC has information. Why? Because every quarter bank is keep on sending the account level information to the FDIC. So then FDIC has the accurate information. So last quarter, example, like, so December 31st, the bank already submitted those information to FDIC. Then after that, between January to till March, like, till March, in between March 15th, the information is there within a bank. Okay. But when the bank is went to fail, then FDIC is discussing that discussion, then they're extracting the all the data as of today, as of the latest day. Okay, so they have all the information. Then FDIC will calculate. Okay, so see, FDIC staff is an location and day and the day it fails. Okay, and identify those who are having insured money in the bank. Okay, and that insurance will be triggered in, and try to pay the money, what are the amount you have it. Okay, and include the interest and everything. Okay, so they'll try to pay. So as I mentioned previously, so only certain accounts are being covered, so not that the stock market account. Okay, so that trading and mutual funds account or ETFs, those will not be covered. Okay, so based on the those things, they start paying the money back to the customer. Okay, so what information is sending to the FDIC? So the banks are sending the information to the FDIC. Means what information? I just gave the just sample information here. Okay, these are very very critical information. So along with this one, there are supplementary information also should be shared to the FDIC. So like customer ID, okay, and account number. Why? Because the if bank face customer, FDIC should know that what is our customer ID and what is account number. Okay, why? Because based on the customer ID, you can identify the multiple accounts. Okay, account number and what kind of account. Okay, or is like kind of thing is the deposit, how much balance we have it. Okay, and insurance eligibility. Okay, I was telling like insurance eligibility. Okay, whether this account is insured or not. Okay, there's insurance flag. Okay, and do we have any collateral? Okay, and what is the collateral he put in? Okay, and sweep account generally it's kind of thing like a merchant account where you get the money into this one, and the settlement is happen in your account, and once the settlement is there, then they just switch to different account. So every end of the day, so that is also like a sweep indicator generally if that account is like a sweep account or not. Okay, and trust is a trust account or our trust account. Okay, any maturity information, so interest rates and everything will be there. These are basic information. So along with this one, you see that an address also there. Okay, like if it is a prepaid card, and maybe you may not be having this much all information, like just for account number, a card number will be there. Those are different level of data. Okay, I just gave you only that's the important information. Along with this information, their address also will be there. Okay. Okay, sorry. Oh, sorry, I missed a slide here. Okay, okay. Yeah, I think it's not going back. Okay, so what happens if the if not at if we are not submit that report, okay, the bank, if the bank is not submitted the report to the um, FDIC, what happened? Okay, so the couple of levels they have it. Okay, so the first one will be like, uh, they'll FDIC, they'll make kind of fine generally. Okay, so if in a given day, $1,000 to $10,000, they'll make a fine. It's vary based on the size of the bank. Okay, so if you take the bigger banks like, so JP Morgan, Wells, and and Bank of America, those are big banks. Okay, so number of customers they have it, so the fine may be a little bigger. Okay, they'll, if you're not submitting it, they start fining that amount. Okay, and after that they'll give some kind of in second level, so they'll give some memorandum generally, like, they order some letters. Okay, and the concern letters why it is being not submitting. Okay, and this is the, you're repeating the you're not submitting those things, it's a public money. Okay, uh, and if the second letter is coming up, means it's try to damage the reputation of the bank. Okay, so that's the reason banks will be very very particular in this reports, regulatory reports. Not only FDIC, any CCAR and Basel are like, FDIC reports, or non-financial regulatory reports also. Definitely they follow certain guidelines, and they do the on time. Okay, so to avoid these kind of things. Okay, so and then third level also, like, so losses, like, they'll try to put some cases. Okay, so then in extreme cases, like, try to um, treat them like, so terminate the bank deposits in insurance. Why? Because they are not in the position to get the reports, right? So they'll try to terminate that insurance. Why? Because FDIC insurance also, they have a lot of amount they have to pay, right? Okay, that is the reason they'll try to avoid that insurances. And also that the last step will be criminal liability. So they'll try to take the control of that entire bank. Okay, okay, and how that is happen generally. So each and every quarter, or every yearly, so they'll try to take all the reports. Okay, like, as a previous slide. Okay, I was mentioning about examine the reports. Okay, and from the bank. Okay, identify the areas of the concern generally when the bank is submitting the balance sheet. Okay, and the loans, and that income and everything, they'll try to examine. And also they'll come to the physically, they'll come to the banks. Okay, and they'll try to talk to the people, how you guys are managing it. Okay, and what kind of rules and regulations you follow, and how you evaluate the loans. Okay, what the process kind of thing. So they'll try to come and have a discussion. Okay, and also based on those kind of things, they'll try to give some ratings. Okay, some ranking generally, like, capital is this one. Okay, and so earning this much, earnings are coming up, and this much liquidity bank is holding up. And those information, they'll try to rank it, not rank it, just kind of link from 1 to 5, what is the rating. Okay, then after that, so try to meet with the bank leadership generally. So initially, that, like, second step, they'll try to discuss that on ground people, like those who are working at the reality, like, loan officers generally, they'll talk initially. And step 4, they'll go back to the leadership level, like, CTO, or like, those kind of level. They'll try to look at it, and they have a discussion. And they raise the concerns about, like, this is not working out, this much loans are not, should not given. Okay, and this, we have very less liquidity, and how you do this one. So finally they'll submit the, like, the examination report will be issued. Okay, so then they was formally, this is the report, they'll try to give it. Okay, then once the report is giving, they published. So that is the final report from FDIC. So in the report, if they see any kind of issues they identify, then bank has to rectify those reports. Okay, So that's the rule. Okay. And who will do generally? Okay, like so what is the advantage generally? So what in big picture generally, what is the advantage? Okay, so the two things generally. Okay, so when it for the bank, it is a detect, you just identify the problem in very early stage. Okay, so every quarter we are reviewing our our capacity, like how we are performing it. Okay, and also like when you're submitting these kind of things. Okay, so people are started trusting banks. Okay, so they are thinking that, oh, this bank is submitting the FDIC reports, then still we can able to maintain the money in that bank. So that federal government is giving the confidence to the people. Okay, and so with that, hence we have money generally, like bank is able to perform a little bit more. Why? Because they can put like better area, they can put something like uh, um, they can earn the money. Okay, so based on the capital market they have it. Okay, and also that should keep on maintain the license for the bank. Okay, and also for the public generally. Okay, so you don't need to run away from a bank generally. Okay, like 1930, before 1930, so it was completely people are running away from uh, running, like try to withdraw the money from the banks. Okay, so that should be avoided. Okay, and also normal protecting the people. Okay, and it avoids some kind of risk generally. Okay, so people are trusting that financial institution, and they maintain their balances. Okay, so these are like final takeaways generally. Okay, so it's not an optional generally, it is a compulsory by each and every bank in the United States. Okay, and also must be quarterly, that has to report it. Okay, and a primary source would be regulatories. Okay, is definitely. So what are the data they are submitting to the FDIC? That data should be accurate one. Okay, so should not have any kind of discrepancy. Okay, so one of slide got missed out. Okay, in between I was not able to go back in previous double click. So each and every team has to be involved. Okay, I mean the IT side. Okay, and IT side, and also like CTO and CAO, and also the CEO also has to be approved that, okay, yes, this data, whatever data we're submitting, it's not accurate data, so there should not be any kind of deviations. Okay, uh, so those will be there. Okay, everyone has a role generally, and CEO, including CEO, has to certify those papers and submit to the FDIC. Any consequences generally, so escalate very easily. Okay, if you're not submitting it in this quarter or this quarter, then it's very early detection, and they'll try to avoid the fines generally. Yearly they'll look for the yearly kind of thing, but since we are submitting quarterly, so then we identify the issues very in early stage. Okay, and this is protecting the customer deposits. Okay, and also stabilize the economy of the country. Okay, thank you. Okay, so this is end of the session.